participating in this morning's webinar, Handling Functional Expenses and Developing Indirect Rates, Best Practices for Effective Nonprofit Financial Operations. My name is Jennifer Disharoon, and I am the Marketing Director at Gelman, Rosenberg & Friedman. I'll be moderating the program today. We have a lot to cover, but I'd like to start with some quick housekeeping items. If you have any technical questions or issues during the webinar, please use the chat function to speak with our webinar administrator for assistance. Technical assistance is also available from WebEx at the number shown here. Please note that this webinar will be recorded and made available on our website following the event. Webinar participants seeking CPE credit for this presentation must complete and submit a short evaluation survey that will appear automatically following this webinar. You will be asked to recall the 3 CPE words shared during the presentation in order to receive the credit. If you have an active pop-up blocker, please take a moment now to disable it so it will not block the survey. Any technical questions about the survey may be addressed to Alina Stone. In addition to the webinar recording, the presentation slides will also be made available for download from our website. As the title of today's webinar implies, the learning objective today is to provide attendees with a better understanding of functional expenses and indirect rates. 1 CPE credit is available to attendees of today's webinar. At this time, I would like to introduce your instructors. Andreas Alejandro is a nonprofit audit partner with over 22 years of experience auditing tax-exempt organizations, including associations, foundations, and other charitable institutions. His work takes him around the world to complete annual audit engagements for a number of international NGO clients. Jennifer Arminger is also a nonprofit audit partner with the firm. She has almost 10 years of experience in nonprofit audit and accounting, and she also serves as a leader in the firm's employee benefit plan audit practice. In front of you now is our agenda for the program. And Jennifer Arminger is going to kick off the discussion with functional expense allocation.
Great. Thank you, Jennifer, and thanks to everyone for joining. We have a really great topic today and really excited that you all are here to join us. And so, as Jennifer mentioned, we are going to start our conversation with the topic of functional expenses. And really, as we have this discussion, we just want you to keep in mind that there are many approaches to the functional expense statement and methodologies. And so every organization will be different. There's no set right or wrong way, but we're certainly going to take a look at and cover some of the more common or best practices that we see in the industry. And so this concept of the functional is a unique accounting and reporting requirement specifically for tax-exempt organizations. And so this does not exist in the for-profit world. And currently, the functional expense statement is actually not a required part of the basic financials. While a majority of nonprofits that we work with and we see do include this, it's not a current requirement. But with the release of the new ASU 2016-14 for the changes in presentation of nonprofit financial statements, that new ASU actually does make it a required part of the basic financials. And so for those organizations that have yet to complete this process or put together a formalized statement, it's certainly important to make sure we understand the approach and how best to present that for the changes that are coming down the line. And so the statement is typically presented in a matrix format, and we have our natural expense categories, so our salaries, our travel, and whatever other expense categories that we've identified are common for the organization, as well as program and supporting services. So within our programs, we could have a number of programs, and supporting services would typically include our management in general, our fundraising, and if we have development. And so the statement and the allocation plan or the process is what spreads our costs across the different programs or the supporting services. And so outside of this functional grouping category being a requirement as part of the 990, it ultimately is used as a measure of efficiency for an organization, and having some way to create a number or a ratio to measure what an organization spends directly related to a mission through those program activities versus what they're spending on supporting services. And so this is really key because the donors and our funders and really the public are looking at this information, and the information is being posted on watchdog sites such as Charity Navigator and GuideStar, and the public and our donors are looking at this information and these ratios, and they're drawing a conclusion about your organization. So it becomes extremely important for that funder and public perception. So one of the first steps for creating this functional expense plan is for your organization to clearly define and really document the different components. And so first, being what are our natural expense categories that we want to present. And ideally, this is going to follow somewhat close to your chart of accounts. And so while the chart of accounts might be a much more detailed level of various accounts, on the functional, we would identify the key natural expense categories such as salaries and benefits, which could potentially have multiple individual accounts in the chart of accounts that roll up into that natural expense. And then even more importantly, or just as important, is for the organization to define its fundamental programs. And so, this is where we see a lot of organizations get hung up on potentially thinking that each individual grant is a program, but really for functional purposes, programs are taken a look at a higher level. What are the core fundamental programs that an organization is running? And so each program could potentially have multiple grants, multiple funders that roll up into that program. And so this practice of identifying our programs really should be done on an annual basis, or taking a look at periodically to make sure it's the best representation of the activities of an organization. And so further, what really occurs in the day-to-day is when we are processing and expending costs, we need to identify which of these costs are deemed direct to those programs. So direct costs in a very general sense are specific to a particular program or objective, so they can be easily identifiable to one specific grant or project or program, versus those that are considered indirect and are being used by a multitude of activities and have the potential to benefit a multitude of activities. And so as we process our day-to-day, understanding what is a direct and an indirect cost. There are typically two common presentations or methodologies for the functional expense. And so one, expenses can be directly applied to the programs and the M&G categories, which is presented in an above-the-line matrix or presentation methodology, or they can be indirectly applied through a pool of costs and an allocation process that takes that pool of costs and spreads it back to the programs. And so this presentation is typically done in one lump sum below the line. And so we do have a couple of examples, or an example of each that we'll take a look at. But before we get into the examples, we first need to just explore a little more about this basis for how we spread the costs. And so the most common answer to that question are salaries and timesheets. And personnel is typically the largest cost to an organization and the largest cost of running programs. So the tracking of the time that is spent working on those programs in turn becomes the basis for spreading those costs. And so again, just the importance of tracking salaries and even more so the internal education across the departments on letting employees know that, their basis, their timesheets, how we fill out a timesheet, what it's used for, and the importance of accurately tracking the time that they're spent, not just putting 8 hours to admin when it could be programmatic in nature, because it in turn becomes a basis for this allocation. There are a multitude of other options besides salaries. Salaries is by far the most common and what we see, and typically the easiest, but it's not a requirement, and there are a multitude of other ways that costs can be spread back to programs. One typical example, it relates to the occupancy, the shared costs of our rent and utilities for an organization, and potentially using square footage as a basis. So whether square footage occupied by program personnel versus administrative personnel, or for example, if you're a more complex organization and you have many locations being directly serving the public and the mission, could be allocated in a different method than headquarters and rolled up into that overall higher allocation methodology. And so I think the important part here, and the important part in identifying all these different components, is to think through what works best for the organization, but more so to document your approach, document your methodologies, and understanding it in the context of reasonableness. I did also just want to mention that for those organizations that are not federally funded, we typically see, and there is a little bit of leeway there, wiggle room on the basis for allocations could potentially be more estimate So whether it's an estimate of the percentage of time spent on programs, there's a little bit of leeway there if you don't have federal funds. However, I will say that to truly understand the efficiency of any program or activity for your organization, obviously the more accurate the reporting is on the time spent working on programs, it will be able to provide better data for you and management and governance to analyze. So we have two examples. The first one that we're looking at here is presented and costs are all being booked and allocated directly above the line, so direct to our programs or our supporting services. And so here you'll see that the natural expense categories are listed on the side. And again, just reiterating that salaries and benefits within our chart of accounts might break down among a multitude of different account numbers. And then across the top are programs. Here specifically, there are two programs to get us to our total. And then our supporting services includes the management in general. And so just taking a look at this statement from a ratio perspective, we could do a quick calculation of the program, so total program services of the $565,000 over the total expenses of $780,000, and that gives us approximately a 73% program ratio, and conversely our supporting services ratio of approximately 27%. And so really analyzing that ratio and where it might fall in an average in the industry, I might say that the 27% is potentially on the high side of an average somewhere between 15 and 25%. And really what I would take a look at and question is that number of 116,000 in the management and general salaries, and what needs to happen internally, and then me as an auditor, we would have a discussion with management and staff to find out if really, a third of their time is being spent doing other work, not program related. And so having those conversations, and again, going back to that internal education, and understanding that is this 33%, a third of my time, reasonable given what I know about the organization and its operations. In our second example, there are a couple differences from the first one that we took a look at. First being that under our supporting services, we have both management and general column as well as a fundraising column, and even more so, we could additionally have a development column, which we see quite often. But another pretty obvious difference is the below-the-line overhead allocation. And so this client has identified a pool of shared costs, so the $1.856 million that are being moved back to the programs and a little to fundraising in accordance with whatever their selected basis for that allocation was. And so, taking a look at the results and again, another just thought process in measuring the efficiency and being able to understand the true costs of running a program, to not only include those costs that are directly identifiable, but to include the support functions of the organization. And so being able to get a big picture for those programs in both a direct and indirect performance sense.
Okay, looks like we've arrived at our first polling question. Have your functional allocation methodologies been reviewed for reasonableness in the last 1 to 3 years? Please make your selections from the possible answers, and while you're answering that question, I'll provide the first CPE word of the day. The first CPE word is daisy, as in flower. Again, the CPE word is daisy. Looks like our results are coming in.
All right, so we were waiting on our polling results, a little bit of technical difficulties, but at this point, we're going to go ahead with our presentation, and I'm going to hand it over to Andreas.
Thanks very much, Jennifer, and thank you all for joining today. In this part of the presentation, we will be discussing indirect rates, including the basic concepts and definitions. And at the end, we'll look at an example of a typical indirect cost rate calculation. First and foremost, we'll discuss the importance of identifying costs and how they fit into the indirect cost rate model. Indirect costing gives management the ability to identify all program costs as well as its administrative costs. The indirect rate calculation allows management and outside parties to see all the costs required to run the organization as a part of carrying out its program activities. Management makes more informed decisions such as where the entity can strengthen infrastructure or where it can trim costs. As a part of the decision-making process, management can periodically review its definitions of cost classification to see how they're defined in its policy manuals to evaluate changes to those definitions. Presentation of ratios. Organizations should help their donors understand the rates and how to translate them into a conclusion that allows them to make good, educated decisions. Recovery of administrative costs. Administrative costs are the costs that represent a fair share of what is due for allowable non-program, non-direct project costs that are necessary to carry out the project or the program. Allocation of cost to programs. This can be accomplished with ease if the cost assumptions are clear and reasonable, and the organization has a reliable accounting system that properly tracks and reports all types of costs. With a good allocation plan in place, those assumptions can be easily communicated to the entity's donors. First, let's start with some basic definitions. Indirect costs. These are costs that are not directly accountable to a specific cost object, such as a particular project or activity. They have multiple cost objectives. As an example, office rent, utilities, insurance, office supplies, and others are basic examples of indirect costs, those that cannot be directly attributed to a project, but indirectly add value to the entity's programs. The indirect rate also allows the organization to systematically allocate costs amongst programs using appropriate assumptions consistently applied from one period to the next, and those assumptions are transparent and properly documented. Donors are very interested in understanding the total cost of the organization, not just the direct cost to run that specific program or project. So it's important for organizations to communicate to donors that they are ultimately responsible for paying a fair share of indirect costs to run the program. And if that fair share reimbursement of costs is not provided, then technically those costs are funded by the entity itself as a loss. So organizations that run many, many projects that generally cannot specifically identify all of its indirect costs specific to a particular project, it certainly is a much better and more efficient approach to allocate those costs using an indirect rate approach. The spreading of costs on a pro rata basis, allocating according to the size of the program activities, taking a simple ratio of allowable indirect costs over total direct costs, is typically the most common and appropriate rate model. So what is the proper rate? Comparing one organization's rate to another is not necessarily an apples-to-apples exercise, as the assumptions and definitions of cost between organizations might be different. There are basic concepts which need to be adhered to, such as understanding and identifying indirect costs, again, defined as costs that have multiple cost objectives, and also direct costs, which is defined as a cost that has a singular cost objective specific to that program or to that activity. But in the end, actual definitions may be different between entities, and the administrative structures and cost assumptions may not be designed exactly from one entity to another. So when it comes to an appropriate indirect rate percentage, we typically hear that 15 to 25% is a good range to fall into. But the most important question is, what kind of rate is being used? What are we applying, and how are we communicating that? Is it based on modified total direct cost methodology, which is simply your allowable indirect expenses over your allowable direct expenses, plus or minus some exclusions and other reclassifications? Are we using a salary and wage related rate, so specific to a element of cost? Or is there another kind of methodology that we're using? Are there multiple rate assumptions, which again, taken at face value, you cannot compare apples to apples from one organization to the next? There are rates available which pull out certain administrative costs, as an example, related to just the administration of subawards. That in the end, the rate for that particular function is much lower, and those costs, when they're pulled out as a separate rate, are not included in the basic indirect cost rate calculation of the organization. So all other indirect costs against all other direct costs, which is essentially the rate that the public is interested in evaluating. So most organizations have a single rate, a simplified rate. So the entity's methodology and how it presents to the public is critical in mitigating negative public perception, or that your rate is not reasonable or within acceptable ranges. When we report to the general public through some of our external documents, such as the Form 990 and audited financial statements, which are most commonly used by donors and prospective donors to draw conclusions, it's important that the methodologies of how we calculate our rate are included in the footnotes of the financial statements, or on our website, or in verbal communications to donors as to how we establish the rate, how they're calculated, and how we support it. In this section, we'll take a look at the indirect rate concepts in a non-federal setting. Indirect cost recovery in this setting is generally lower than the classic indirect cost recovery provided under federal assistance programs. However, it's not accurate to assume this in every single case. In some cases, they're going to be a function of negotiations with the donor. Depending on the organization's ability to understand budgeting for full cost recovery, classic indirect costs may be billed as direct costs, so a lower rate may or will not impact the organization's overall reimbursement opportunity. What happens in this case is the entity is recovering a lower percentage on a larger pool of costs. That pool including classic indirect costs that donors are willing to consider as directly chargeable expenses, and then that pool is subject to the indirect rate application and recovery. So in the end, a fair share of reimbursement may be afforded. Many organizations get caught up in situations where they believe they're missing out on recovery opportunities, again, because the rate looks lower than it actually is. So the budget assumptions are critical, as the actual recovery may be in line with its actual classic indirect recovery model, which is afforded through the federal indirect cost rate recovery model. Ultimately, the federal government might be the best donor because they will pay the full indirect rate in most cases. But once again, federal and foreign government recovery may afford similar reimbursement opportunities. We just need to be exceptionally strategic as to how we budget and how we structure those proposals. An organization should also be prepared to walk away from funds that don't provide for a full or fair indirect cost recovery. If we're willing to accept a lower overall recovery, and that recovery is structured like a classic indirect over direct model, then it is understood that that gap must come from somewhere. It has to come from unrestricted gifts that we raise during the year from organizations' reserves, which means that we just need to plan for that, and we need to fundraise for those gaps, for those losses in the current year or in future years. So we just need to be mindful of, again, how we enter into the relationship with the donor, how they reimburse costs, perhaps in a very non-standard recovery model, but we need to be accepting grants or other assistance awards that allow us to recover as much of the administrative burden as possible to run that program.
Okay, we've come to the second polling question this morning. We'd like to know, does your organization currently have a negotiated indirect rate agreement, otherwise known as NICRA? Please select an answer and go ahead and respond to the poll. While we're waiting for your answers, I'll give you the second CPE word. The second CPE word is rose. Again, the second CPE word is rose. Okay, looks like the poll has concluded. Andreas, back to you.
Thank you, Jennifer. In this section, we will take a look at the indirect rate concepts in a federal setting. There are published guidelines under the former OMB circulars, which are now included in CFR 200, also known as Uniform Guidance. With these regulations, there are a few changes to not only the financial and compliance audit requirements, but also to the approach related to the indirect cost rate preparation. CFR 200, specifically Appendix 4, sets the standards which organizations must follow in determining the classification of cost in relation to the preparation of its indirect rate. It is important to understand the basic concepts to ensure that the preparation of the rate is reasonable and consistent from one reporting period to the next. So what is a federal indirect cost rate and how does it work? The rate is simply a mechanism for determining fairly within the boundaries of sound administrative cost principles what proportion of indirect cost each program should bear. Indirect costs are incurred for common or joint objectives and cannot be readily identified with a particular grant contract or other activity of the organization. The basic concepts are similar to what we've discussed in prior sections of the presentation, but spelled out in Uniform Guidance. The indirect cost rate is the ratio between total indirect expenses and a defined cost base. The indirect cost rate allocation methods used by each organization could depend on its structure, program functions, and of course, its accounting system. So the question is, who's covered and what awards are covered? Any organizations that draw funds directly as a prime recipient from the U.S. government should apply for a negotiated indirect cost rate agreement, a NICRA, and reaffirm that rate on an annual basis, assuming a simplified methodology, and we'll talk about the methodologies in a few moments. A nonprofit organization which has not previously established an indirect cost rate with a federal agency would submit an indirect cost proposal initially, right after the organization is advised that an award will be made. The proposal is prepared by the organization in accordance with applicable federal cost principles to substantiate its claim for the reimbursement of indirect costs. The rate calculation and the supporting schedules are used to arrive at the indirect cost pool amount in the base calculations. These proposals are generally based on the most recent financial data supported by the organization's audited financial statements. The basis, the main part of this being the entity's functional expense statement, which is in those statements. And of course, we've talked about functional expense statements and the preparation of those statements, and it's exceptionally critical, especially when we get to the point of negotiating with the U.S. government as to what our definitions are and how we plan on recovering indirect costs. The federal agency with the largest dollar volume of awards with an organization will generally be designated as a cognizant agency for the negotiation and approval of the indirect cost rate. Assuming a simplified method, the negotiated indirect cost rate, and we'll talk about the types in just a couple of slides ahead. Entities with the NICRA are required to submit a new indirect cost rate at the end of each fiscal year with its cognizant agency. And just as an example, the overhead special cost and closeout branch under the Office of Acquisition and Assistance is authorized to negotiate indirect cost rates for agreements under USAID programs. And so if you receive a significant amount of your funding from USAID, generally speaking, you will probably have USAID, this specific branch, as the cognizant agency that reviews the indirect rates. The rates for the current year are typically certified by the external auditor in the body of the Uniform Guidance Audit Report, and are based on the final audit expense figures. And this division, we'll refer to them as the NICRA office from this point forward. They review the rates and subsequently provide for a final rate for that year and a provisional rate for the subsequent year. And the provisional rate is important because it allows the organization, without too much work and without too many changes that might happen in that subsequent year, draw funds from the government indirect costs using that provisional rate. It's important to understand four basic concepts related to the identification and the assignment of costs for the purpose of rate determination. The total cost of administering a federal award is the sum of the allowable and allocable indirect costs. To be allowable, the cost must be necessary and reasonable for the proper and efficient operation of the program, must be consistent with policies and procedures that apply uniformly to federally financed and other activities of the organization. So that is an important attribute here. Consistently treated amongst all activities of the organization, determined in accordance with GAAP and applied consistently, and adequately documented. A cost is reasonable if the nature of the goods or services received and the amount reflect an action that a prudent person would have taken at the time that the decision to incur the cost was made. Some of the major considerations include whether or not the cost is recognized as ordinary and necessary for the operation of the organization or the performance of the award, that the cost was incurred in an arm's length transaction, and that it was incurred prudently by individuals properly responsible and with the best interests of the company in mind. A cost is considered consistently treated if the treatment of that expense is applied in a similar manner from one period to the next. Consistency is important when you're preparing the rate to ensure there aren't any deviations in the assumptions from one period to the next. And a cost is considered allocable to a particular cost objective if the goods or services acquired to meet the cost objectives, considering the relative benefits received. Considerations related to allocability include evaluating the cost objective and whether or not it is necessary to the overall operation of the organization. So in this section, we'll talk about the different types of indirect rates. And as we mentioned earlier, the NICRA office, and it'll change from one cognizant agency to another. But typically speaking, if you elect the NICRA route, which is the one that you would reaffirm on an annual basis, you would have a provisional and a final indirect cost rate conclusion, and that would be documented in a letter that you will be receiving on an annual basis. It may not be timely with the end of your with the end of your fiscal year or your calendar year. But certainly at the end of that period, you will be receiving a final document. There are also predetermined and fixed rates. They're not used as often, but they are available. And so under CFR 200, you can elect the provisional and final rate. The provisional rate, again, is simply a temporary indirect cost rate that's applicable to a specific period for funding and reimbursement. And so irrespective of what you're currently operating at, and it should be looked at on a periodic basis, you have a document that states that you can draw indirect costs for the current period using this provisional rate, which has been approved by the cognizant agency. And the final rate would be the rate applicable to the prior year, and is based on the actual known costs for that particular period. The final rate is not subject to adjustment, so it's certainly very important that before the rate is finalized that we're certainly aware of the fact that that is final for that particular year. And once it's established, it will be the basis for adjusting indirect cost rate claimed in that prior period, and it's the basis for the provisional rate going forward in the upcoming year. A predetermined rate is a permanent rate established for a specific current or future period, and it's not subject to adjustment. It's used where there are awards where there's reasonable assurance that it's not likely to exceed a rate based on actual costs. It's enforced for a longer period of time, but you don't need to reconfirm that rate on an annual basis. And a fixed rate is also another rate for a future prospective period of time. Costs are determined by, of course, you're coming out of the accounting system, and the difference between the fixed and actual are carried forward to a future period, usually timed to your fiscal year, and are adjusted for any over or under recovery. The provisional and final rate, the annual NICRA concept, is most preferred because you are allocating costs in the appropriate period. You're matching indirects to directs in the year that you're incurring them. You don't have any carry forwards coming from previous periods. They're all being recognized in the current year, and so there would be no profit or loss generated for that particular year because it's a simple cost reimbursement methodology. There's also the de minimis rate, which CFR 200 came up with the 10% de minimis rate to solve issues related to calculating rates and donors assigning rates, especially when you don't have a NICRA. So when you don't have a negotiated rate, you can charge funders 10% regardless of what your actual rate is. And when you do have others that you're passing assistance along to, if you have subrecipients, you should be honoring that de minimis as well. However, if your sub has a NICRA, then you should honor their NICRA or negotiate with them as to how much indirect costs you will be providing to the subrecipient. So there are three basic methods for allocating indirect costs under CFR 200, the simplified method, multiple allocation, and direct allocation. The simplified method is generally used when you have one main programmatic activity with multiple grants. Under this method, you would evenly spread indirect costs to all grants. So this is the most common and most preferred methodology. We talked earlier about modified total direct cost recovery. This is the one that you would typically see most organizations following, and it's the most predictable, and it falls within those ranges that donors are looking for. So do you fall within that 15 to 25%? Do you fall below or above? And but this would be under the simplified methodology. The multiple allocation base generally is used when there is more than one office. Large international NGOs and other organizations with regional offices that may have different rate bases may elect a multiple rate methodology. And the direct allocation method is when the organization treats all costs as direct costs. So all costs are charged as direct. And typically speaking, this happens when you have an organization that is 100% financed with federal funds. But you have some options in here. The most common is the simplified method. Defining elements of cost. The entity's financial statements are the basis for calculating the rate. This really is the starting point. So the preparation of the functional expense statement is the starting point, and the indirect cost rate calculation should reconcile to the functional categories and other categories for indirect cost rate reporting purposes. Reclassification should be disclosed in the notes to the indirect cost rate if there are reclassifications. And if you have general and administrative expenses that have been functionally reported as program costs, then those costs should be recaptured when you do prepare the indirect cost rate by reclassifying them in the indirect cost rate presentation. And we'll take a look at an example in just a few moments. Selected items of cost. Subpart E in CFR 200 includes certain elements of costs, identifying specific elements of costs that are considered to be distorting items, such as subgrants, equipment purchases, if we're classifying those as expenses, and others should be removed from the direct cost base as they generally are significant, and the U.S. government does not believe that the entity should be recovering full indirects on items that are deemed to be distorting transactions. Subgrants over $25,000 are, per instance, are usually removed from the base. So if you have an award that's $1 million, then you're recovering indirects on the first $25,000. There are organizations that have negotiated with different thresholds. So the $25,000 is the default, but there are organizations with much higher exclusions from the direct cost base. Vehicles and other assets over $5,000, if we elect capitalization, wouldn't even fall into this category under uniform guidance. When you do have an asset with an estimated useful life over a year, it should be capitalized. There are organizations that have equipment that have a service life of less than a year, and those may be included in the cost base, and those should be excluded if they're deemed to be distorting items for the presentation of the indirect cost rate. Travel is a significant cost, and consideration to international travel and related exclusions should be looked at when we're preparing our indirect rate. Other selected items of cost, typical unallowable expenses. There's a whole list of unallowable expenses in CFR 200. Classic unallawables include bad debts, contingencies, donations and contributions, entertainment costs, interest, and others. And we should evaluate each and every one of those for exclusion from the direct cost pool. Fundraising expenses for the purpose of preparation of the indirect cost rate calculation should be included in the base. So typically speaking, and under a simplified method, your allowable indirects would be your numerator, and your allowable directs would be in the denominator, including your fundraising expenses, including lobbying expenditures as well as other adjustments, and we'll look at an example in just a moment.
Okay, we've come to our third and final polling question. Does your organization have definitions and policies in place to be able to properly calculate indirects? Your possible answers are listed there. Please go ahead and record your answers now, and while you're recording your answers, I'll provide the third CPE word. The third CPE word is tulip. Again, the third CPE word is tulip. Okay, the poll has ended.
So looking at the last couple of slides here, we have an example on the next one. This particular one just simply lays out in a simplified methodology what the direct cost base would include. And we talked about the base would include all of your program service expenses that are present in your functional expense statement, including fundraising expenses, because again, those are not deemed to be indirect expenses for recovery purposes. And some of the adjustments from the base include the removal of unallowable expenses, grants and other types of instruments over $25,000 or whatever the negotiated threshold is. Would include a reallocation of administrative costs, and we'll talk about those in just a second, but those would typically be those costs that we've included in our indirect pool that are certainly in the spirit of our programmatic purposes and should be reported as direct expenses for recovery purposes. And so we may classify them in our accounting system and the like as indirects, but they truly are program expenses for the preparation of the indirect cost rate. And equipment and other capital expenditures that are expensed, if they are expensed, they need to be removed because, again, they're deemed to be distorting items. And the indirect cost pool starts with the management and general expenses as reported by the functional expense statement of the organization. Some of the adjustments coming out of there would be unallowable costs, lobbying expenditures again, and then any administrative expenses that we deem to be, again, furthering the mission of the organization. However, for reporting purposes, we've grouped them into our management and general pool of costs. And here we're looking at a sample rate calculation. The sample rate calculation starts with the direct cost base. The functional expense statement reports $60 million of program service costs, $2 million of fundraising. So that's our starting point, the $62 million. We need to start the preparation of the presentation of the indirect rate with our known numbers coming from our audited financial statements or from other statements that will be the basis for our indirect rate presentation to the NICRA office or to donors. From the $62 million, we are adding in unallowable expenses, which had come to the base from the numerator. And down below, you'll see there's some exclusions of unallowable expenses to the tune of $200,000, of which $50,000 was deemed to be costs incurred that for recovery purposes are not recoverable. But for preparation of the indirect cost rate, these costs do add value to the program activity of the organization, so they come back into the base. Grants and contracts and other assistance awards over $25,000. Anything above $25,000 per instance in this case would come out because they're deemed to be distorting items. And they're distorting again because the government does not believe, depending on how you've negotiated that threshold, that beyond a certain threshold, if it's $25,000 or $100,000 or whatever that threshold is, that there is enough administrative cost burden to the organization for administering that relationship with that subawardee. And so we can collect on the first 25 or whatever our threshold is, and above that, it's excluded from the base. So we're at our allowable direct cost base of $49 million. And then the indirect, the numerator starts with our management general costs. We extract out all of our unallawables. And again, under CFR 200, there's a very voluminous listing of unallowable expenses or types of expenses. And under the simplified method, you have a very simple calculation here on the right, which comes out to 15.9%, and that percent optically looks very nice. And again, we've talked about how we communicate to donors, how we calculate rates, how we set up defined policy and procedures to be able to capture costs appropriately, and then we have our accounting system that translates those into actual percentages. So getting to this point does start with definitions. It does start with policy and procedures. And once we've established those and we're consistently applying those from one period to the next, and we are recording costs in our accounting system consistently, then we can get to a point where we do have this rate calculation coming out with reliable, reasonable figures and supportable figures in the event they are questioned by outside donors or others. The most important entity that's questioning the rate would be, again, the NICRA office that we're submitting the rate to at the end of the year. So that concludes the sample rate calculation under this specific example.
Okay, thank you, Andreas. Before we wrap up today's webinar, we want to answer a few of the questions submitted by the participants. And it looks like we have a few questions about fundraising and development. Jennifer, are both fundraising and development considered supporting services?
Yes. So the supporting services could potentially include three categories in general. And so the first being our management in general, or our general and administrative, whatever you tend to call it, as well as fundraising and then development. And so some organizations choose to split those two out. And specifically for those organizations that have that negotiated indirect rates, the NICRA. So the difference is that the fundraising is included as part of the direct cost base in the denominator for NICRA purposes, but development is included in the G&A pool, and so that is why some organizations would want to distinguish between those two categories. But yes, they're both ultimately a supporting service on the functional expense statement.
Okay, thank you. We have another question about indirect costs in a multi-donor environment. Andreas, can you address this one? How should an indirect cost be tracked in the system in a multi-donor environment, and how should this be billed to donors?
That is an excellent question, and there are a few different ways to accomplish this. And so we talked about how certain donors are willing to pay indirects on direct costs, as well as those types of expenses that we would classically categorize as indirect, such as rent and other administrative type expenditures that for federal NICRA purposes would all fall into the indirect cost pool. And so this is it's a very hot topic, especially when we do have federal money and when we do have foreign government money, and the rate structures are exceptionally different. And so it's important that within the accounting system, we do have a characterization of a cost that we believe is recoverable 100% by, let's say, a foreign government donor or another type of donor, where for federal reporting purposes, we would have to categorize that as a general administrative expense, which would fall into the indirect cost pool, the administrative cost pool. And so having specific categorizations, again, that pull out those costs that, again, those indirect costs that we are recovering 100% and keeping them separate from the indirect cost pool, the numerator in that indirect rate, will allow us to prepare a federally approved rate that excludes those costs that we have recovered 100%. So again, the indirect cost rate allows us to take all of our administrative expenses and spread those amongst the programs. But if you've collected 100% of that administrative expense, then that needs to be pulled out and presented separately.
Okay, thank you. I think with the time we have left, we have time for one or two more questions. Here's one that's come up a couple of times. What do we need to do to justify the de minimis rate of 10%? Jen, can you talk about that one?
Yeah, sure. And actually, you're right. This question does come up a lot, especially because this concept of a de minimis rate is new within the last couple of years, established by the rollout of the new uniform guidance. And so the guidance established this de minimis, and that organizations that don't have negotiated rate can choose to collect a flat rate of what they assigned as 10%. And so there were a lot of questions in the industry as to, well, you know, what do we need to do to justify that 10%? And the answer is that you don't. It is just a flat rate, regardless of what your organizational rate may be. However, you know, it's important for your internal budgeting purposes and just your analysis of program performance to monitor what your actual indirect rate is against that 10%. So if there are funding gaps, shortages, that you understand that those will be covered by other unrestricted operational reserves or funding.
Okay, thank you. We've received a lot of questions, but I think we really only have time for one more. Andreas, we've got one that says, what if our final rate and provisional rate are different and the grants are already closed? Okay,
so provisional and final rates, chances are, will from one year to the next not be the same. So if we have a provisional rate and we close out the year and it's different, then that's more likely the situation. But if we have grants that we need to close, we definitely do not want to be closing those grants until we have the final rate established for the periods in question. And so there is some concern about this because there are organizations that may be waiting several years for the rates to be finalized. And I've seen recently organizations that have proactively reached out to these closeout offices, these divisions, and have requested expedited rate assignment. And so you want to be on top of that to make sure that you are closing grants in a timely manner, but you don't want to close them truthfully until you have your final rates assigned for the periods in question.
Okay, thank you. All right, well, with that, we want to thank everyone for attending today's webinar. You see the contact information for each of our presenters. And we want to encourage you to join us again next month for our next webinar on implementing the new FASB not-for-profit standard, presentation of financial statements for not-for-profit entities. Remember, please, to complete the survey that follows if you would like to earn 1 CPE credit for attending today. Thank you again for attending, and have a wonderful day.